While retail investors are hitting the panic button over short-term volatility, the smart money is playing a completely different game. The world's largest asset managers are executing what may turn out to be the largest capital migration in modern financial history. Not a trade, not a cycle, a structural shift. And if you think BlackRock is here just to trade a Bitcoin ETF, you are missing the forest for the trees. Retail thinks this is a Bitcoin cycle. BlackRock thinks this is the end of the old financial system. The ETF isn't the destination, it's the Trojan horse. The real endgame isn't Bitcoin, it's a $16 trillion market opportunity called tokenization. If you're only watching the price, you're already late. Here is the hard truth. Capitulating now is exactly what the institutions want you to do. Hi everyone, you are watching Global Macro and Crypto. Today, we are going to peel back the layers and dismantle the real thesis behind this institutional migration toward on-chain finance. We are going to talk about what the rise of the tokenized economy actually means for capital markets, who holds the leverage, who controls the rails, and where power ultimately concentrates. But to understand the solution, we first have to confront the problem. Despite how clean and modern your banking app looks on an iPhone, the global financial system underneath is painfully archaic. It is like bolting a Ferrari body kit onto a horse and buggy. The user interface looks modern. The infrastructure underneath is not. Instant transfers are mostly an illusion. Behind the scenes, the settlement layer, the actual plumbing of global finance, still runs on technology that has not seen a meaningful upgrade since the 1970s. Take a standard equity trade. When you sell a stock, the transaction does not actually finish when you click Sell. It enters a multi-layered clearing and settlement process where your cash does not fully arrive for 2 business days. This is known as T+2, meaning your capital sits in limbo for 48 hours. On an individual level, that delay feels like a minor inconvenience. On a systemic level, it creates massive counterparty risk. The risk that one party in the chain fails before settlement completes. To manage that risk, clearinghouses are forced to lock up enormous amounts of collateral. Billions of dollars sit idle purely to ensure nobody defaults. Banks employ large operational teams whose only job is to reconcile mismatched ledgers across institutions that do not share a common record. And in a high-interest rate environment, capital sitting idle for 2 days is not neutral. It is expensive. That is dead money. This is the snail mail era of finance. Slow, inefficient, fragile. And this is where the retail narrative breaks down completely. The institutional thesis for crypto has already evolved. It is no longer centered on digital gold. It is no longer about price speculation or number go up. It is about rails, the infrastructure that moves, settles, and accounts for value. Giants like BlackRock, Franklin Templeton, and Fidelity are not adopting blockchain technology because they love volatility or believe in crypto ideology. They are adopting it because they want efficiency. They want margin preservation. And increasingly, they want operational survival. Blockchain offers 3 structural advantages that legacy finance cannot replicate. First, atomic settlement. Either a trade completes instantly, or it does not happen at all. There is no limbo period, no settlement gap. Trades finalize in seconds, not days, and they do so 24 hours a day, 365 days a year. Second, ledger unification. Instead of dozens of institutions maintaining separate, constantly mismatched databases, everyone references the same shared ledger, a single source of truth often described as the golden record. This eliminates reconciliation costs almost entirely. And third, programmability. This is the real game changer. Smart contracts allow compliance checks, dividend payments, interest distribution, and reporting to be handled automatically by code rather than by people. Processes that once took days, teams, and paperwork can now execute deterministically. This is not ideology. It is not a philosophical debate. It is math. In a world where the cost of capital is high, every day that money sits idle is profit destroyed. Tokenization unlocks that trapped capital and puts it back into circulation. Now, here is the paradox confusing the market. On the surface, Bitcoin's price action looks choppy. It is volatile. Retail sentiment swings wildly between euphoria and despair. But beneath the noise, beneath the daily candles, institutional infrastructure is being built at record speed. While retail investors argue about meme coins on social media, the world's largest asset managers are quietly building on Ethereum and other Layer 1 blockchains, base settlement networks that secure transactions at the protocol level. There is a massive disconnect between crypto as a casino, which is how retail often experiences it, and crypto as a settlement layer, which is how Wall Street evaluates it. Retail obsesses over volatility. Institutions obsess over utility. BlackRock has been explicit about this distinction. Larry Fink has gone on record stating that the next evolution of markets is the tokenization of financial assets. We are talking about stocks, bonds, real estate, private credit, all of it moving on-chain. Let's make this tangible. Traditionally, investing in a prime commercial building, say a skyscraper in Manhattan, required millions of dollars and months of legal paperwork. And once invested, your capital was locked. The asset was illiquid. You could not sell a single brick to meet short-term cash needs. Tokenization fractures that asset. That same $50 million building becomes 50 million digital tokens. Ownership is divided into programmable units. Anyone can now buy $10 worth. This is known as fractionalization. But the real breakthrough is yield. Instead of waiting for quarterly distributions processed through banks and administrators, rental income can be streamed directly to a digital wallet, in real time, second by second. And if liquidity is needed, you do not call a broker or wait weeks for a buyer. You swap the real estate token instantly for a stablecoin, a blockchain-based digital dollar, just like selling a stock. We are effectively transforming the most illiquid assets on Earth into liquid financial instruments. This dramatically increases the velocity of money, how quickly capital can move and be reused throughout the economy. This is not just faster trading. It is a structural shift comparable to the transition from physical mail to email. The entire nature of value transfer is changing, and this shift is no longer theoretical. Exhibit A, BUIDL. BlackRock launched the BlackRock USD Institutional Digital Liquidity Fund on the Ethereum blockchain. Its ticker is BUIDL. It tokenizes US Treasury bills. This is not a pilot. This is not a white paper. It is a live product. In just months, it attracted over $500 million in assets under management, surpassing many crypto-native projects that have existed for years. This proves a critical point. For institutions, the perceived risk of using public blockchains is now lower than the opportunity cost of remaining on legacy rails. Exhibit B, the $16 trillion projection. According to a joint report by Boston Consulting Group and ADDX, the market for tokenized illiquid assets could reach $16 trillion by 2030. For context, the entire crypto market today fluctuates around $2 to $3 trillion. Tokenized real-world assets alone could be multiple times larger. This is not a wave. This is a liquidity tsunami. Exhibit C, stablecoins. Stablecoins are no longer fringe tools for traders. They are becoming systemic players in the U.S. Treasury market. Tether alone holds more U.S. government debt than several G7 nations. Regulators are beginning to understand why this matters. Stablecoins export U.S. dollar dominance. If the settlement layer of the digital economy runs on dollar-backed tokens, global demand for U.S. debt increases. This leads to a deeper geopolitical layer, the currency war. If global trade migrates onto blockchain rails and the dollar is not the native settlement asset, U.S. financial influence erodes. That is why stablecoins are being regulated, not banned. They are the digital extension of the dollar. But this transition is not frictionless. Crypto was born permissionless. Wall Street requires compliance, KYC, and control. A tokenized treasury bill is not Bitcoin. It can be frozen, seized, or revoked by the issuer. What is emerging is a hybrid system, part decentralized, part centralized, often called CeDeFi. The market will likely bifurcate. One side will be permissionless DeFi, open, volatile, and ideologically pure. The other will be institutional finance, compliant assets operating inside controlled environments. The risk is not that decentralization disappears. The risk is that liquidity migrates elsewhere. So what is the endgame? BlackRock is not invading crypto to destroy it. They are absorbing its technology to upgrade their own systems. By the end of this decade, the distinction between traditional portfolios and crypto portfolios may vanish entirely. Assets will simply live on ledgers. The winners will not be chasing the fastest horse. They will own the racetrack. Layer 1 blockchains, Oracle networks, interoperability infrastructure. This is not a short-term trade. It is a 5 to 10-year structural transition. Watch where institutions are building. That is where liquidity will concentrate. And always distinguish infrastructure from applications. In the next video, I will break down exactly which rails actually matter and which ones are just noise. Thanks for watching Global Macro and Crypto. I will see you in the next one. If this added clarity to your perspective, hit like and subscribe. Now let me ask you this. Is the tokenized economy modernization, or is it financial surveillance with better user experience? Leave your view in the comments below. This content is for educational purposes only and does not constitute financial or investment advice. Always do your own research.